comes down to computers communicating.
The information superhighway can be a confusing mix of on-ramps and off-ramps.
Bitcoin is worthless artificial gold.
Is it still rat poison?
Probably rat poison squared.
We need to get into the world of, okay, this is actually foundational technology.
What the Internet of Money does is it creates a single network which can do a microtransaction to a gigatransaction.
The Internet is going to be one of the major forces for reducing the role of government. The one thing that's missing, but that will soon be developed, is a reliable e-cash.
All righty, gentlemen, welcome back to another episode of Final Settlement. Today is Monday, March 30th, 12:13 p.m. Eastern Standard Time. Gentlemen, how are we doing?
Well, I was just wondering, how many weeks do we have to record this podcast at $67,000? Is there a time do we hang back? If people wouldn't mind, if they wouldn't mind missing us for a week, just comment, like and subscribe, and then comment and be like, hey guys, don't kill yourself every week.
Maybe there's price thresholds where we unlock a new episode, so we don't record again until we're over 70, and then maybe like 72.
There's things happening, but they're just less around. There's some stuff happening in Bitcoin and digital assets, but it's the broader world that is, we just got to be careful how much we cover there. Maybe people don't care.
Yeah. Beware of the algos. It's always been tough to discern signal from noise, but I think it's particularly difficult over the past few weeks, given everything going on in the world. But, I think it was kind of a big week, Michael. We were, in the group chat prior to recording this morning, you're like, it's kind of a slow week, not that much happened. I kind of think some important things happened. So maybe we'll jump right into it. This was a story from last week, which we've covered to some extent because this is sort of a compounding story, if you will. We knew about it a few months ago, but there's more and more information coming out. So this is Morgan Stanley entering the Bitcoin ETF race. And so this was announced a few months ago that they would be doing this. What we've talked about previously is effectively, this is a departure from Morgan Stanley's typical sort of strategy. They're not a huge ETF provider. They don't do this often in terms of putting their name on a fund like this or a product like this. And they are, effectively going to compete with IBIT, BlackRock's Bitcoin ETF. And this came out late on Friday afternoon last week that they would price the spot Bitcoin ETF at 14 basis points. So I think IBIT is 25. I think there's a few others that are maybe in the 20s. But basically, this is now the cheapest Bitcoin ETF product on the market. So they're undercutting the whole complex. And to me, this is a pretty strong signal that they aren't playing around here. They're playing for keeps. This is game on. In the sense that, not only are they departing from sort of their typical strategy around products like this, but, they're sort of, everyone else has had a 2-year head start. So, IBIT in particular is at 60, 70 billion in AUM as we sit here today. So they got some catching up to do. And this is one way to do it, just undercut them on fees. And this is also something we've talked about in the past around, these ETF wrappers, if they're not super differentiated in any meaningful way, the ways you differentiate are effectively brand, name, distribution, and then ultimately the fee rate. And so I think that's exactly what we're seeing play out here. Thoughts, guys?
Yeah. I mean, I think this is fascinating. There's a couple of things that come to mind. One is, to your point, they're playing for keeps. They want to be a real player in this new digital asset world. I think we're going to have Chris Kuiper on to talk about it, but I put them up with like Fidelity as the most sophisticated at this point. Now, I would still give the leg to Fidelity for being around 10 plus years, building a lot of that platform out. But everything that we've seen and heard from Morgan Stanley is they're planning to play a big part in not only Bitcoin custody, because they're not only just doing the ETFs, like they're fundamentally different than what BlackRock's doing, in my view, because they've expressed that they plan to build custody solutions, spot Bitcoin mine. But the other thing that I think is really interesting is that they recognize, and this is part of why I'm saying that they're one of the most sophisticated, is they're playing for keeps because it is the thing to play for keeps for. That if this asset is going to grow long term, you're going to monetize it way beyond just those 14 bips because you're bringing it into your platform, you're bringing it into your ecosystem. If you're going to inevitably see that people will allow for delivery, well, what better way than to pull that asset at $70,000, $80,000, pull it away from BlackRock, and then build other financial products, whether it's spot custody, because most of their significant, their clients are sophisticated, they're high net worth private clients. They understand that they will want things above the ETF. I think this gets lost on the market, that the market may think, oh, ETFs will persist forever, and it's just the Bitcoin natives that don't like it or doesn't make sense. It's like, no. The most sophisticated participants, the Morgan Stanleys and Fidelities, understand that their high net worth clients that are worth hundreds of millions of dollars and have tens of millions, if not hundreds of millions of dollars in exposure to IBIT, will demand better products over time, from assurances, SMAs. There's a whole slew of reasons why they would want that outside of a wrapper. And the kicker is Morgan Stanley's a bank. And that's what obviously made this interesting, right? It's because it's the first bank to do it. But then the banking experience, when you're able to let lending happen against that asset, mortgages, just anything under the sun, they will be in a better place to monetize those assets. So it seems to make a lot of sense that you're able to undercut the market, still monetize it, but then ultimately bring those assets in. And this is really probably just a cornerstone of their digital asset strategy. They have a lot of other things that they're working on.
Yeah, well said. And I think the one thing that's being missed when considering this too is by building their own custody in-house and their own system around digital assets as a whole, they're going to not have to outsource to Coinbase forever. Obviously, they're using Coinbase for the custody and I believe some trade execution at this stage in the game, but being able to do it in-house, similar to, I think FalconX bought Invesco and was able to bring that ETF in-house. And so one, they obviously want to get as much assets under the platform as they can because that'll start to get them a lot more interest just with the asset holders as a whole. They were the first ones, I believe, from the very start when IBIT started offering their ETF, they offered it to clients and were able to solicit that when not all the other banks were being quite as digital asset forward. And so, yeah, I mean, they also are willing to, this is speculation, but I assume that they're going to be losing money right at the beginning, unless they are able to get a ton of new clients on the platform. And we haven't seen any firms out there that are from the traditional finance space take any sort of long time horizon view on the asset in particular. BlackRock, it was like their most profitable ETF year one. And so, yeah, I mean, I think this is going to be a massive boon for the space and a smart move by Morgan Stanley in particular, and should be a good catalyst for the industry that has lacked one for the last 4 to 6 months, with this launching in the next 2 weeks or so. Yeah. Thanks for pointing that out. It does sound like this is going to be launching pretty soon in the next few weeks, which is exciting. And then the only other things to sort of reiterate and pull out, and Michael, you mentioned this, but this is the first real bank issuer. So if you think about BlackRock, Fidelity, these other Bitcoin ETF issuers, they're all sort of asset managers. They're not actually traditional banks. Morgan Stanley is the first real bank to be doing something like this. And they have over $9 trillion in sort of client advised assets, which is just sort of mind boggling of a number. And they have 16,000 advisors. And previously to this announcement of this product, they had sort of formalized a recommendation around crypto Bitcoin digital assets of sort of 0 to 4% in portfolios. And previously they were basically allowing their clients to invest in IBIT or Fidelity's ETF within that sort of 0 to 4% band. And this move is effectively validation of there's real client demand there, but we no longer want to cede those management fees to BlackRock and Fidelity. So we need our own product to capture those fees for ourselves. And so, yeah, this is a big deal. The other thing I'll point out is I think there's a fee waiver. So I think there's on the first $5 billion, I believe, It's no fee. And so another signal that they want to get strong sort of swiftly out the gate with this thing.
Yeah. It sounds like this morning they just got approved. So I would expect it probably starts trading, at least this week, if not next. This is interesting from a market structure perspective of like demand, because I think retail buyers have historically chased price. And it's not to say that private wealth clients won't chase price and momentum, but they're a little bit more agnostic, especially if the advisors are able to solicit. And it also ties into, it's just a different buyer. Like you can imagine, Bitcoin's always had this like platypus style appeal where it has different properties and different value props. And they don't have to be long the dollar ending. They just have to be long, whether it's like tech or innovation or whatever, digital gold, whatever they put in front of them. It's just a different dynamic than Bitcoin needing to rip to 110 before they step in. Now, obviously people will step in there, but I do think it's an interesting component because we saw this happen with IBIT and the demand that had been, kind of latent until that product was released.
Yeah, 100%. And sort of as you mentioned, this is part of a broader sort of institutional infrastructure build out. So I wanted to switch over to this clip, Morgan Stanley's head of digital asset strategy, Amy Oldenburg, talking about sort of some of the other plans. So we'll play this clip here. Sec.
Even on the institutional security side, the one thing that we wanted to talk about today is turning on our dark pools, so our trajectory cross to support tokenized equities by the end of 2026. So this is happening this year. There's a lot of activity in all divisions, and we'll continue to power through 26 and then more to come in 27.
Yeah, I thought this was fascinating. I mean, there's a couple of things. One is this team has been looking at this space for a very long time. Hopefully we get up there this year, but Brian and I attended the SALT conference. I think it was an inaugural one back in 24, and got a chance to sit down with Amy and really understand their level of not only sophistication, but just like thesis on where this market is and where value will accrue. And it wasn't around 1,001 cryptocurrencies. It was around real infrastructure. And I think after all these conversations, the way to distill why I find the tokenization aspect interesting and as like a canary to where Bitcoin's growth will come from is that we all understand that the token just represents a claim on something underlying somewhere else. It's the same way as the dollar. The dollar's still inflating and somebody's still holding the treasuries. But there's a current arbitrage happening right now across legacy rails, right? Because that's all the dollar movement on stablecoins is like, okay, now anybody can build effectively like a neobank, and then it manages money movement in a more efficient way. And a great angle or anecdote to share is the MoneyGram CEO, I guess, was on a panel because this was explained from the guy that he was on a panel with during the DAS conference. And he was saying that crypto, Bitcoin, it's all a scam. But stablecoins are the best innovation he's ever seen, because he was referencing that instant settlement he's had forever. The problem is he had to put up a $3 billion float to get that instant settlement, and his stock's only trading at a couple $1 billion. So what he's effectively doing is now able to leverage stablecoins, go rebuy back his shares. But then he's starting to think about in the market of like, well, now if everyone can hold those dollars, do I give them a wallet? Do they generate interest? Can they spend on it? Right? Like it just opens up all these things that just didn't exist before. And so that's where I think the tokenization aspect will be interesting, is regardless if it's dark pools and the inefficiencies around moving those equities into whoever's authorized to participate there, or if it's secondary markets, or if it's private markets that have historically been really hard and liquid. I'm not saying it's positive or negative. It is just a arbitrage on the inefficiency of the legacy system. And the problem is that the legacy system made a bunch of money via that bureaucracy and all of the, 9 to 5, whatever occurred, where they built their moats. And so now, because of the administration, a lot of the non-commercial and commercial things we can say around the incentives, you're just going to have the firms that are willing to play ball and build on this new frontier. And it's kind of cool because they're doing it, but also anybody can do it. We talked about Alpaca as an example, a firm now that anybody can integrate equities into their market. You don't have to become a broker dealer. So I think it's just fascinating that they're looking at it. They see the market being disrupted and they're deciding to disrupt themselves before somebody else does.
100%. All right. The other big story
Wait,
from last week.
before we move on to Morgan Stanley, so
Go for it.
where do we think
Liam just accepted a job at Morgan Stanley. That's what I thought. That's what I thought he was going to say.
where do we think that their ETF is in terms of AUM by the end of the year? If
That's a good question.
IBIT's at around just over 50 billion right now, just under 800,000 Bitcoin held. Fidelity is just under 200,000 Bitcoin and like 13 billion. Where do you guys think that Morgan Stanley's Bitcoin ETF is at the end of the year?
I would say just shy of Fidelity.
Shy of Fidelity?
Yeah. I think for this year, I think it'll be, I think the other part of the question Liam didn't ask, but
It's price dependent, right? To some extent.
But is it?
I kind of think
Like,
it is.
Well,
I think.
Well, you could do it in Bitcoin terms then too.
Yeah, no, I mean more like things accelerate rapidly in my mind if like the Bitcoin price is moving up as opposed to just chopping sideways for the rest of the year.
But I guess I guess maybe what Liam's asking and the question is more of price stays 70 to 100K bound. How much demand comes from their 14,000 advisors soliciting?
Right. Yeah. So I had ran some numbers last week, and basically, if
you ran the numbers,
I ran a few back of the envelope, back of the napkin numbers. If their entire client base allocated 0.5%, it would basically be like half of IBIT. So call it 300 to 400,000 BTC. If they did 1%, double that. So basically rivaling IBIT. Now, their entire client base is not going to allocate, right? Like that's kind of probably not the way to think about it. But on average, on sort of a look-through basis, maybe they get to 0.25 to 0.5% because some clients are going to allocate 10, 15, 20%, and others are going to do 0. So I kind of think that they'll surpass Fidelity perhaps and start rivaling IBIT towards the end of the year.
One question on that from your experience. I mean, for either of you guys, but mainly Brian, because of being at the bank, what would you say is the amount of flow? Like, let's say Brown Brothers decided to launch an ETF. What percentage of flow that went from Brown Brothers accounts into IBIT would move over into the native platform? And then what percentage directionally would people not that get off 0 that had not because the advisor solicited?
Yeah, great question. I think it's multifaceted and in some sense, if I'm comparing it to what I saw, because it's a perfect question because we had both external products that we brought into the platform, and then we also had internal products that were managed by Brown Brothers investment management arm that we would then sort of solicit to our private banking clients. And the uptick on those was always greater than any of the external products because it was basically like, not only is this your best thinking from an investment perspective, but this is an in-house product. Why would I not support what you guys are doing? The fees are typically lower than anything that we would have gotten external. And so all of that is to say the uptick's pretty high, whether, it was even the external stuff that we recommend to clients, it was still, because it was coming from our recommendation and we were soliciting to it, like the uptick was, call it anywhere from 50 to 75% on anything external. So there's, maybe a quarter of clients that would opt out of certain funds or strategies. And then on the internal stuff, it was like probably closer to 90% of like people are going to be allocated to those things.
It's pretty bullish, especially like you got the backdrop of the fundamentals of Bitcoin. But then if you say, well, and it's also lower price by,
that's
50%.
That's what I'll caveat all of those numbers I just threw out in the sense that, what I'm talking about in terms of those recommendations, it was all equity strategies. So it was things they were familiar with, right? It wasn't Bitcoin. So I think you could probably haircut those numbers by a little bit because it's Bitcoin and not something that every client is super familiar or comfortable with. But yes, anything that's internal and being actively solicited is going to have a pretty high uptick, generally speaking.
Yeah. I'm going to forecast right around the Fidelity mark, just because the new product, it sounds like some folks probably will immediately sell their IBIT and buy MSBTC because they would have to lock in capital gains on that too, which is annoying for some folks who want to optimize for taxes. And then Fidelity just has all of their spot BTC too, which I don't know exactly how much they hold there, but I would imagine it's probably just about the same ish as their Bitcoin ETF that they custody. So I'm going to go about where FBTC is, like 200 to 250 KBTC.
I know we've kind of beaten this, but one like other angle just to add is because it came across last week, but it continues to is there is a lot of holders like spot Bitcoin holders, self custody, Onramp, whatever it might be, that won't put any retirement assets or any kind of like ETF assets into anywhere except for Fidelity, and they won't tell their friends, their family to go into anything other than Fidelity simply because of custody, because they look at Coinbase and they see a risk. And so that's just going to be something very interesting to watch play out because Fidelity, again, maybe it wasn't as kind. They're probably the most sophisticated because they actually built out custody. And that is a real differentiator now, but then definitely in the future when risk comes out and you're just offloading. And even Morgan Stanley had to do this to get to market is go through Coinbase. So I do think that's going to be a growing issue. We obviously have, what we think will be the future. But I think it's going to be interesting also because I've talked to ETF providers on and I don't know what the SEC response and pushback would be if they offered even in a diversified custody arrangement, similar to I think Valkyrie or whoever. I think Valkyrie got bought, but at the time they were doing BitGo and Coinbase, that there's a reality that they could diversify because with one of the firms or guys I was talking to last week, he's probably listening, he works with one of the ETF providers and nobody really knows about that. They didn't get a lot of flow. They focus somewhere else. But the point being is that it's a real differentiator to advisors. If you can be able to say oh, this is a different form of custody, more assurances. But it's still early, but I expect that to pick up, especially when most people forget. Remember when Bitcoin got to 120? People were freaking out about Coinbase because at the time it was Coinbase sitting on 800 billion in total assets. And so you have this honeypot and then and most people don't understand the terms of service. There is no assurances. There is no insurance. Insurance is, window dressing. So it's going to be an interesting thing to follow too on custody and differentiation on a long enough time.
100%. And we will move on. Only other thing, Liam, to your point around cost basis, Morgan Stanley didn't start allowing their clients to invest in the other Bitcoin ETFs until August 24. So it's unlikely that their clients have a cost basis around 40, 50, because by August, I think Bitcoin was well over where it is now, or 60, 70, 80 perhaps. So I would say, depending on when those clients came into the other ETFs like IBIT, they could be underwater and it could make a lot of sense for them to switch into Morgan's product. Okay, we are going to move on. The other big news item from last week, we'll have a few Coinbase related topics, but this one is, I guess, somewhat of a positive one in the sense that they announced in tandem with Fannie Mae and a company called Tether, Coinbase powers the first crypto-backed conforming mortgages. And so basically, in practical terms, what this means is you can now pledge your BTC for effectively a down payment on a home and set up a sort of Bitcoin-backed mortgage, if you will. This is interesting from a number of aspects. I'm curious what you guys think. I mean, to me, the biggest takeaway is why is this interesting? It's because it's different than just taking out a loan and putting down a down payment in the sense that the terms are sort of unaffected by Bitcoin's volatility. So there's some risk being taken by Fannie Mae and I guess Better in some sense that you're not going to get mortgage or you're not going to get margin called on this product like you would in a typical Bitcoin backed loan. So that's why it would be generally attractive to someone who's looking to buy a house, has a lot of Bitcoin. Now there's obvious drawbacks with this. It's custodied at Coinbase. And so you have single counterparty risk with this, and it's a long duration product. So do you want to have your Bitcoin encumbered at Coinbase for the next 30 years? Probably not. But curious what you guys think about this.
Yeah, I think this is pretty fascinating and just big for the industry as a whole and for folks who don't want to sell their Bitcoin. It is pretty over collateralized. So I believe it's 40% LTVs. So it should be able to handle some downturn. But I think in general, this is a really, what's to say? Yeah, like it's Bitcoin price or the value of the mortgage is completely unaffected by Bitcoin's volatility, et cetera. I think that this is big for folks who don't want to sell their Bitcoin and just Bitcoin getting cross collateralized further with other assets out there. It's interesting that Coinbase, despite posturing themselves as a everything app and spending a lot of time on sports gambling and the altcoin casino, is really only pushing Bitcoin as and USDC as the two assets that they'll offer for collateral at this point, which I think just shows a little bit more on how different folks are underwriting the actual viability of a lot of these tokens long term. I think that this is a massive thing to see. I'm just honestly surprised that this is such a big news through Better, and it sounds like the rates are a good bit are higher than getting a traditional loan with other collateral outside of if you just have equities or cash or whatever. So I would just imagine that this market gets more and more competitive over time. There are more lenders who are willing and able to actually go out and do this as well. But great to see.
Yeah, this is I was working on a diagram to pull up on this. I think this is huge. I think the net of it is we can hit the nail on the head in the sense of there's underlying market structure problems with, like, if you're going to trust Coinbase with a 10 to 30 year collateral obligation. But the reality is we have to start somewhere. And there's been a lot of wealth accumulated in Bitcoin. It's also interesting, right? It's Bitcoin, it's not Ethereum or Solana, but it's a lot of wealth accumulated in Bitcoin. And the market has treated individuals with Bitcoin holding as like aliens. They don't want to work with them. I had a lot of conversations. So I have a lot of anecdotes. I was talking to a client last week, and he referenced that, he's pretty long BTC in all different form factors, ETFs, IRAs, personal accounts, spot custody. And he needed to buy a home, and he couldn't lend against his ETF holdings from like the origination of that capital, right? Because they want to see it in your bank account for a few months, and then it naturally needs to come from, I think, depending on where the bank is. So they couldn't see it. They looked at IBIT. So he effectively had to like spot sell X hundreds of thousands of dollars to get his house, right? Because a lot of individuals listening, they probably know it's generally a guy thing where you're like, look, I don't mind renting, but your significant other wants you to buy a home. That's societal pressures, whatever it is. And so you have to really work through, timing the market, the tax obligations, all the different things that go into it. And so the ability to, it's still relative, like the big value props here are no liquidations. And then the interest rate are going to be, yes, higher than a standard conforming loan, but it's still lower than what the traditional market is, the cost of capital for private markets when it comes to taking out just a Bitcoin loan. So you don't have that volatility risk of getting liquidated. You have a lower, blended rate from the house mortgage. You have like one general, mortgage or monthly payment. And you retain the appreciation. So you don't have to pay the cap gains, and you retain the appreciation. If you're long BTC, it's a real interesting movement. And then I guess the last part is that these mortgages that are issued by Better are conforming. So Fannie Mae and the powers that be, the government effectively will buy them, which allows for more capital to come in. Because if they were non-conforming, then it gets more complex when it comes to who's going to buy those loans from a capital perspective. So it's very cool to see. I think this is just the beginning. We've been talking to folks that are looking to build things on this space, but for real sophisticated clients or people that understand, okay, this is great, but this is the V1. Do you really want long-term Coinbase to hold those assets? And you want anybody to hold those assets for 30 years. That's the real problem with custody, is no custodians lasted X number of years. So to expect for a long duration financial instrument to be there for 20 or 30 years is still a question. You want to get that assumption out of the way. But either way, I think it's very good to see from a market structure perspective, and just really like from, TradFi realizing this thing is collateral. This thing does allow for people to buy homes, and there's going to be a lot of banks, I think, interested in a model like this.
100%. Very well said. Got to start somewhere. This is a great V1. But there will be more. There will be more of this because it's a product that people need in the sense that, to your point, there's been a lot of wealth created with Bitcoin, and the intuition is to not sell it because there's more upside ahead. And so, but people need to live their lives. They need to buy homes. They need to do things. So something like this makes a lot of sense. Okay, moving on. Digital Asset Roundtable, stablecoin segment of the show, Michael's favorite topics. We're going to talk a little Clarity Act. I don't know how much new news there is here. It seems like we're continuing to sort of move forward in terms of this debate. Some people are mad, some people are happy. I think Coinbase withdrew its support again, and now stablecoin yield in Crypto Clarity Act is saying it won't allow rewards on balances. We've talked about this in the past. I think there's going to be basically a compromise, some sort of negotiation compromise around effectively a qualifying action, if you will. So they're not just going to allow you to have completely, just stagnant balances doing nothing, earning these rewards. But if there's a qualifying action, there's going to be sort of workflows and workarounds to allow these things to pay quote unquote rewards or stablecoin yield. Maybe Michael, I'll hand it to you because I know you've been following this closely and what's the latest, or how do you think this all shakes out ultimately?
Yeah, I mean, it sounds like this has all been hanging by the thread of like whatever Coinbase wants to go. Because my understanding that Coinbase has been the one holding it up. I haven't thought deeply about it, but it's kind of interesting that they are the ones holding it up. It sounds like from market participants, like people in this market, investors, builders, they just want something to be passed. They see the clarity as a strong sign for their business to move on. I think there's like this implied overhang of that once this, is passed, we're going to be in a better position for the price of digital assets or Bitcoin. But the one of the learnings, and maybe this is obvious, but because Coinbase is the largest donator to I forgot what the pact is on the political side, is that the politicians can't afford or do not want to go against or dissent to piss off Coinbase because they effectively pull that capital. That's my understanding of like why they hold so much weight. So yeah, I think that everything's moving in the exact same thing we reported on last week. I do think this probably ends up sooner than later, simply because there's a lot of, I think, administration goals and incentives to get this in place from market forces. And so, yeah, I think my gut shot is that this is done by Q2.
Yeah, I would imagine that there needs to get something done before the midterms later this year. And just because it seems like Republicans are projected to lose, Democrats seem to be a little bit less friendly to the digital asset space as a whole. So while this definitely isn't perfect and seems to, not necessarily create the best outcome for consumers is typically the case, there likely will be something done and should be a catalyst for price.
Two things just to call out here. One is, I don't know why I was thinking about this morning, but that whole term of like people say you don't hate the media enough. I don't think people hate the banks enough, because if you think about it, like the banks pay you nothing. They overdraft you. They charge insane interest on your credit cards. And this technology opens up to democratize and then also further, because I don't think anybody questions that stablecoins will provide more efficiency and innovation for just like capital movement. And they're against it. It's a pretty wild proposition. So there's that aspect. And then there's this other one where, I don't know who this guy is. I think he's somewhere. I mean, he has a .eth, but he has this term because WAP had brought something into their marketplace, which WAP is a standard, like, technology marketplace for goods and services. He put, what non-crypto people don't realize is that crypto makes it possible for every app, and just put like dollars, to become a bank and offer yield on balances, payments, investments, and a lot more. Every app where people get paid, Instacart, DoorDash, Uber, etc., will become banking and brokerages. I think this is something that fundamentally almost everyone's missing. That's not really looking at this space, because if you're Uber, DoorDash, Best Buy, whatever that gives gift cards, these are effectively like a similar mechanism where you can bring in, carry that float, pass it back as a customer acquisition, or retain it for your balance sheet. And then ultimately you can start to build better, it's a newer design surface because now you can lend against it, move money, whatever it might be. And so I had this tweet above it, which was like, that's 100% correct. When value transfer doesn't have the legacy rail barriers to deal with, everyone that transfers value starts to look like a bank in fintech. And then this goes to the point of like, yes, it starts with stable coins because people understand dollars. But if once they realize that their dollars is crushing them from an inflation perspective, then it ends with Bitcoin. And so that's why I really continue to like look at this innovative like surface area that stable coins are bringing, because ultimately, I think it's inevitable that it ends with Bitcoin, and this is just the order of operations that had to take place or has to take place.
Check out earlyriders.com for all the latest in Bitcoin investment research. Now back to the show.
Very well said. Okay, moving on. A few other headlines here. BitGo, quarterly earnings. Liam, I'm going to hand this to you. Any major takeaways since they IPO'd? The stock is down pretty materially. I think it IPO'd around maybe $20 a share. It's now at around $7. Not too surprising given what the market's done since their IPO. But any takeaways from their latest earnings report?
Not, just one that's worth calling out is the compression of trade fees. I think that they went from around 47 bips to 21. I think that as more and more folks come into the space, the ETFs just get thrown around as kind of high velocity. That's going to be something that's going to come down across the industry, especially for more institutional type players too. Outside of that, they continue to grow their asset base. It's interesting. They obviously got the OCC charter and should be a massive boon for them. Just being one of the few institutional type players who has the banking charter. But yeah, they're a little bit more resilient than some of the other players in the space who have gone public recently, just because of the nature of being B2B2C, having SaaS like type revenues. But I think that just the nature of the market, until there's something cleaned up with the Clarity and Parity Acts, I think that publicly traded companies in the space are going to be hit because of it.
Yeah, I will say the interesting thing to see play out is I think Belshi recently, I saw a clip or something where he was like calling the IPO where we're at as like the V1, first inning. And I do think that's fascinating to think about when we're still so early. And if you have this amount of assets, where do you monetize and how do you execute on them? It's going to be interesting to see that play out. You mentioned the banking charter, which obviously gives a lot of legal momentum and regulatory momentum. But there's like an interesting dynamic on orchestration of stablecoins as an example, where there's no shortage of people coming into the space, and BitGo's doing that. But I forget who I was having this conversation with, but it's like Stripe and Bridge are stepping in a big way with Tempo, and they understand that, right? Like they're not so old. They're old enough to be dangerous, but they're not too old to not want to touch this or be late, right? They did the Bridge acquisition. They did the Privy acquisition. So you have them playing from the orchestration level, and then you obviously have Circle and Coinbase. So I don't necessarily know if where does BitGo shine there? And they can, but there's other players doing it. So it's going to be interesting to just see where that monetization and that growth comes from. But they have no shortage of different, like diversified client base, and then just treated like crypto assets in general that I just think it's going to be interesting to see where this plays out for the next 10 years. You can see the stock trade and be relatively flat and more of an infrastructure play, or they can figure out where's the future of this stuff monetized, and then where are they going to offer direct B2C products, and then where are they going to go B2B2C, because people stepping in to be that bank, to be that custodian, don't want to build that out, and that's where they go to BitGo.
For sure. Definitely agree. First inning. You can't take too much from the stock price being down over the first few months when Bitcoin price has done what it's done. So Belshi's playing a long game here, obviously. this one was, I'll be honest, I hadn't seen this next headline, um, but somewhat related in the sense that Gemini also went public recently within the past several months, and stock price not doing too hot, and they are being sued. So, either of you, any thoughts on this class action lawsuit against Gemini for basically misrepresenting the uh, quality or trajectory of the business? I think is what's effectively being claimed here.
Yeah, I think that, there's two interesting points to pull out from this. One, I have no idea who's going to win, or if they've said anything that was potentially misleading, but it sounds like they at least the lawsuit claims, yeah, they overstated the commitment and viability to growing to the platform. Post IPO financial plans were overstated, and there was, a potential risk of restructuring, just given how loss making the business is overall. I think that one thing to call out is probably, if this is happening, it's definitely going to happen with a bunch of those DATs that recently went public, and it's going to be interesting to see what ends up happening there, who ends up winning or losing that. But there was also just a shocking number of the losses are expected to continue through 2029 for this business. The company's been around for a while, and would have imagined that, prior to going public, they would have done some, getting fit. But just was kind of shocking that, if you're just almost like a trading platform that we touched on earlier, that's not necessarily where the value is going to accrue long term.
Yeah, I historically would not have much on equity research, but this made me think about a number of things. One of them is Gemini. It's always been understood they lack direction. Like if you go back to the genesis of that business, at least from my understanding, is the Winklevi twins set it up because they were initially trying to launch an ETF. They needed a custody solution that got pushed. Gemini turned into a business, and it's historically always been all over the place. It really had a lacking of leadership from a founding perspective, and what it was ultimately. That's what happens when you don't fundamentally understand Bitcoin and ends up crypto and digital assets and the rest. And so the question would be like, well, if that was the case and their books were always, a little fragile, why would you go public? And this is kind of what we see in the status of the market, that it's not a fundamentals play, it's a momentum play. So the market was hot, everyone was going in, and it's eerily similar to what Liam called out as the DATs, because the DATs were all momentum and fundamentals, or lacking fundamentals. And I expect to see more of this, in the sense of I saw, without calling them out, a DAT. I don't know what had come up. It was something about their earnings being like just completely missing the mark. And so I just put it in perplexity, I think, because I think it has a little bit better analysis when it comes to like some of the research on the finance side. And it just chopped up everything that happened in the past quarter. And it was insane because they had all these promises on cards that were going to be delivered and usage and just everything, the banking partners. And it was just like within seconds, like, no, they shit the bed on what they promised. And the point in sharing that is, I think, like, because these tools are so close, there's going to be more people that are scrutinizing them when historically they'd have to go through these filings. You're going to have more lawsuits. And if anybody's just curious on any of their favorite DAT, if you go look at it, like a lot of these DATs don't even hold a large percentage of what they went public with, because when he went through this, it wasn't even a filing, it was just breaking it down. It was like the lending mechanism to give them the Bitcoin was not really their Bitcoin. Then they had to puke it out because the debt couldn't get service. And it was just like this real hairy situation that nobody knows about. And if they knew, everyone like that was involved would just be chastised by the industry. And so I just expect like this is part of that, because they didn't necessarily have the direction. It talks about in this doc or another one, how they had promised, or generally when you see a growth company, you're going into emerging or external international markets, and they're withdrawing from those markets, like Europe and I think London or UK. And so, yeah, I think we're just going to see more of this. There was no real fundamentals. They obviously have this like crazy business where there's like 300 to 500 employees, and they're not generally generating any kind of profit. And then the last thing I will say is I'll make a call. The Gemini probably gets acquired by the end of the year, because that's the thing. I was talking to a client of Gemini's, or has some IRA, some assets. I don't know what it was. And I was like, they're going to be okay. This isn't like a bucket shop in the sense that they're regulated by NYDFS. they're backed by founders that have billions of dollars, I believe, in Bitcoin, and they do have a valuable asset in the sense that banks are interested in this infrastructure. So I don't think there's any worry on their assets. But from a fundamental like equity perspective, if you're buying them because you hope the stock's going to appreciate, it's the same thing in my mind as like buying a debt. Like it's just tied to Bitcoin's price. There's no fundamental there, and if the price comes back, then their equity might have some lift. But I do think they'll be acquired. I would put a hard bet that within the next 2 years, whatever that is, like 21 months. But I think it'd be interesting and could see it by the end of this year.
If the Bitcoin price doubled tomorrow, would you feel good about how it's being secured right now? Most people have not really pressure tested that, and I get it. I have talked to people who have self-custodied for over a decade and others who've stayed on exchanges because they could never get comfortable managing their own keys. Both camps have real concerns. That is why we built Onramp, multi-institution custody, so no single company can lose it, move it, or use it. Lloyd's of London insurance, inheritance planning built in, and a team that can walk you through the entire setup. Get started in 15 minutes. Book a free consultation at onrampbitcoin.com. Onramp, secured by 3, controlled by me.
Interesting. We shall see. Kind of in a weird way related to everything we just talked about in terms of the DApp plays, Bitcoin as a treasury asset. I thought this was kind of interesting. GameStop came out and reported that there was some rumors, I guess, a few months ago that they had moved some of their Bitcoin that they bought about a year ago to Coinbase Prime. People thought they were about to sell it. In reality, they're actually just doing a covered call strategy with the Bitcoin, which is really interesting in the sense that, like, you know, if you're trying to build a Bitcoin treasury and sort of do the quasi DApp play, but then you're now capping your upside with these covered calls. And I believe the strike prices of the calls that they've written are around like 105 to 110 K for Bitcoin price. It kind of like defeats the purpose of like having the Bitcoin on the balance sheet in the first place, because now no one's going to buy it for the long-term sort of Bitcoin upside. They're just kind of doing this to, I guess, generate some, you know, near-term quote unquote yield, some income on this stack, which is, I guess, interesting in its own right. But to me, it kind of signals like they did it because there was a lot of pressure for them to buy Bitcoin with all the cash they had. And now they're kind of like questioning why they did that. And so they're trying to salvage it by getting some near-term income and then kind of giving up on the longer-term upside for the asset.
Yeah, I mean, the public markets are a mess, man. Like, I don't know. When you look at all this stuff, it's key. I was going to pull it up, but if you guys remember when whatever his name is, Ryan, I think the CEO is Ryan something, came out and put the Bitcoin on the balance sheet, or did that big $500 million buy. And it was like during the Bitcoin conference last year. And it was like a very not motivating claim, right? And I think Parker had a tweet was like, this is not how you want your CEO to operate if they just bought $8.5 billion in Bitcoin.
He was like, we'll see if it we'll see if it works out.
Yeah.
It was the most tepid thesis.
And so like, I mean, we harp on it enough, so I don't know, we don't have to go deep, but like these DATs, everything's just grasping at straws that I see it, because it's like, we're going to put stretch on the balance sheet. We're going to do this. We have more BTC potentially per share, but we're still trading below. We're like, everyone's down 80 to 90%. And you know, there's a real issue that doesn't get discussed enough around how many people are going along with it because they'll get sued to shit. Like just completely wrecked legally. Because like a good mental model, or just like not mental model, but a good thought exercise is like, how long does the price stay around here where these things trade below where they're at and people just start leaving to AI, to whatever, right? It's like, so like, what changes? The price of Bitcoin goes up, 24 or 36 months. And the only thing I can think of that would keep people just hanging around singing about DATs is that you're just going to get sued, and you made some money. Maybe you didn't even make the money, but yeah, because this GameStop deal is an exact example of it. To your point, they have like a fundamental thesis and they went completely against it. I don't even know what the strategy is there. It's like either puke it or don't. But now you're becoming like a hedge fund.
Yeah, very, very strange. And great transition. You didn't mean to do this, but people pivoting to AI, that's what Marathon is allegedly doing here. And we've seen this. This isn't like brand new in the sense that public Bitcoin miners have sort of been diversifying over the past couple of years into AI data center infrastructure. And this is sort of just the latest development in that story. Marathon selling a bunch of Bitcoin to retire some debt and then really push heavier into the AI side.
Yeah, I mean, the quick thing just to pull up here is this other tweet, because I think this is like mining's not my forte, but it's been largely understood.
Yeah, this was great.
That these guys are operating at a loss. I think it's a little small, but yeah, these guys are operating at a loss. They're leveraging the public markets. I think Fred Thiel made like $54 million last year. And this actually is really, you see this across the industry where people are subsidized by others, whether it's venture or like here, the public markets, and it really hurts. Long term from the fundamentals, like, the right business will win, but short term, if you have people like a Marathon or others being able to increase the hash rate, effectively making it harder for smaller miners to operate, it's not good. And I think our buddy Boomer, what's his name? From
Bob Burnett.
Bob Burnett. He's been talking about this for a long time. And so anyway, the last thing to say is it goes back to just like, what are these firms? What do they really exist as? Why were they accumulating? Why are they leveraging the markets? I think they put on a lot of debt to be able to play the DAT trade and have a largest holdings because the public markets were rewarding them for that. And now that that's no longer in vogue, they're starting to puke this stuff out, which goes back to the main point of all of this is what goes up must come down if the fundamentals weren't there. And so if somebody deeply understands Bitcoin and wants to hold it, that's a completely different market structure and health of a market than people playing a short-term game, because yes, it feels good right up front, but ultimately it's going to end up in this just like sideways chop to down because people have to puke all this Bitcoin that they're not going to hold before we're able to, go back.
Yeah, I think the GameStop trade is just what's hot at the moment, and then so becoming a DAT was hot, and then doing covered calls was hot, and then now they're just kind of pivoting away from that. And same exact thing with Marathon. I'm pretty sure that they issued a convertible note at 115,000 Bitcoin in order to buy more and become a little bit more of a DAT play then. And now AI is higher than Bitcoin, so they're selling some of their Bitcoin to retire debt and move more into the AI space. I think it's unfortunately just, what you see with this industry is a lot of, I'm not going to say marathons kind of fly by night, but a lot of just kind of following the crowd and seeing what's hot rather than, focusing on fundamentals too.
Yeah. All well said. All right, guys, we've got maybe 10 minutes or so left. Where do you want to go? We've got a few things on the list remaining. We could go to the latest Square Cash App news. We could go to Tether Audit. We could go to SpaceX. We could go to Coinbase gambling app. Where do you want to go?
I think we should give service to the Square stuff. I haven't followed it as closely. I think my understanding is like they just basically turned it on for everyone now.
So it sounds like Square just enabled Bitcoin for payment across all its different terminals. This went live today for the first batch of cohorts, and they're turning it on in more of a phased approach across all of their merchants over the next month or so. And so, yeah, it says on the screen, all U.S. sellers will begin
the uptake
having
on doing
Bitcoin
this probably
payments
less,
automatically enabled, but sellers will
it could have been because there was a few steps
by
involved in
default
actually
unless they want
turning
to
it
turn
on.
on actually accepting Bitcoin and keeping it on their side. So it just automatically sells it. I think it's just a great thing to see in terms of the increased knowledge of Bitcoin and having it get out into the wild a little bit more so than it already is. Unfortunately, the reality is many people just don't use Bitcoin for everyday payments at this stage. And so it's a little bit early, but I like that they're pushing it out there.
Yeah, I think the two big unlocks or the innovations happening here, the innovation and the unlock. The innovation is that you can obfuscate the payment rails, because this is something that you'll see more and more of, like real category winners is just Lightning, Bitcoin's in the background, and you can provide whatever incentive, whatever process to effectively take in the Bitcoin, sweep to dollars, bypass interchange, right? They're doing over Lightning, and you can even do that in reverse. I don't necessarily know if that's like right off the bat. You probably have to turn it on, but if you can pay in dollars over Lightning, auto convert to BTC or Lightning without worrying about interchange, I think that work stream and flow is something that will grow, and that's like real innovation on a like technology perspective. The other thing is that you just have market penetration around the amount of people turning it on with already within the user experience, meaning that there's already, I think it's like tens of millions of people with Cash App, and then there's tens of thousands of people with the terminals. And so that's a big component. And then right now, where the de minimis tax situations, out there, this kind of like bypasses it, because you're not effectively spending the Bitcoin; it's being transferred. No, I guess you're spending your Bitcoin if you're there, but the merchant doesn't have to work.
If something happened to you tomorrow, could your family access your Bitcoin? Not probably, not they would figure it out with certainty. I thought about this a lot. You may feel confident managing your own keys, but are your loved ones? Billions in Bitcoin have been lost already because someone died without a plan. With Onramp, inheritance planning is built in directly into your custody setup. Your Bitcoin stays segregated and in your control, insured through Lloyd's of London, and accessible to the people you choose when they need it. Get started in 15 minutes. Book a free consultation at onrampbitcoin.com. Onramp, secured by 3, controlled by me.
Worry about it.
Yeah, that's well said, and probably going to be a stronger boon for getting de minimis tax exemptions on Bitcoin actually passed, although it's not looking that's the status quo at this point. Do we want to touch on Tether? It sounds
Yeah,
like
let's do it real quick.
they recently have signed up a Big Four accounting firm to complete their first full audit. It is a KPMG. Circle stock, I think, was down 19% on the day that this was announced, although there was some Clarity Act news announced on that same day. So wanted to turn it over to you for any thoughts on this one.
Yeah, I don't have any broad thoughts, because my understanding is Tether's worked or talked about getting an audit for a while. I mean, it makes sense that they need to get an audit if they're going to operate USAT in the United States, and they're going to want some kind of credibility. I thought it was interesting that when they announced this, Coinbase, and it's not because of it, but it's just interesting timing. Coinbase took a nosedive from an equity, their valuation or their stock, I think, went down 20 to 30%. There also could be the component of the Genius Act, and what does that look like from passing earn, and then the growth of stablecoins. But yeah, not much there. I think I think outside of the audit, it's kind of like expected if you're going to be operating there. The only other thing is I think we discount in financial services trust and brand. And for better or worse, in the traditional markets, when it comes to USDC, and then even like Stripe and what they're doing with Tempo, specifically with like Paradigm, that those are the first two calls for firms building in the United States. And we obviously know Tether has its emerging market and outside the US dominance, but I don't think an audit just naturally supports there. Now they have a balance sheet to establish liquidity and growth, but I think people just discount the relationships with, the parties that are involved and the history, that it just doesn't make it a foregone conclusion that capital markets will want to be moving around USAT when there's other options.
Yeah, completely agreed. It'll be interesting to see. Obviously, they've mostly seen a lot of demand from exchanges at this point, so will be interesting to see if some of the large players support USAT, but imagine that they would go more towards Circle, at least for a V1.
Yeah. Do you want to pull up your I didn't see it, but I'm curious your thoughts, the most successful teams spending on AI?
Yeah. So we can touch on this briefly. Essentially,
I can pull it up too.
yeah. So this Ramp CEO or maybe CTO put out an article about just getting on the right side of the ice, and essentially it's really about just how to leverage the latest tools that are coming out and the compounding gap that we've seen between those who are really focused on the space and doing as much as you can, doing more with less, and actually adopting AI into their workflows. And the real gap was just the top 25 spenders of AI are growing their revenue over 100% since 2022, where the bottom 25% of AI spenders by company have kept pace with the US economy as a whole, or slightly outperformed it and growing less than 20% of their revenue there. I just thought it was really telling. It's not necessarily a correlation that the best folks, if you spend more on AI, that your revenues automatically going to grow. But I do think it's a testament to how those who are really forward thinking are just operating at a different level than the traditional incumbents, and how that's kind of translating into how they think about their entire company, and the different increasing divergence between those who are outperforming and those who aren't, as AI compounds things.
Yeah, I think that makes a lot of sense. I mean, it's fascinating to see they have the data behind that in the growth. It's an interesting one, like we should look at and trying to discern the signal here, because you can manipulate numbers obviously, but really looking at like the growth, the specific like anecdotes from the companies, because I don't even doubt this. I think like us being able to put, let's call it 5 companies that were in this, and then show where they're finding the growth and how they're leveraging these tools, will be fascinating. I think this ties into the other tweet that was from, I think it was the CEO of Stripe, and then there was a guy Karpathy or whatever, however you pronounce his name, that was, I don't know if he's a co-founder at OpenAI, but it was basically the point of engineering. Like the biggest problems with engineering are generally around like DevOps, getting services, payments, databases, security, domain names. It's not actually the coding. And so when you think about agents and just this new world, you can just see how it's not even squint anymore, how you're going to need to transfer value online. And while we've been talking, or me personally, about stable coins, and yes, that's going to be the V1, I think that on a short enough time frame, not even long enough, you're really going to see emergence around some level of Bitcoin. Now, I don't know what it looks like. If it's Lightning, just thinking out loud, it could even be something like Spark, where you have this own like side chain that's for AI. And because a lot of these firms, you're still going to have, for better or worse, embedded governance and KYC. Because you can imagine, like, if you need to set up a bank account for whatever reason, and you have a Bitcoin, a native firm like Erebor, like you still have compliance and reasons why you need to know who, like, that agent's tied to on the behalf, if recourse or whatever happens. And it's a little harder when it's just a Satoshi that's not necessarily tagged to anybody. But the point being is that this is somebody that's deep in the domain expertise of engineering, explaining that engineering has historically not been the hard part. It's the DevOps around tying and stitching the whole thing together. And you need native value to do that, to incentivize that coordination. And I thought that's just super fascinating, because we're just going to see that side of the market emerge, while Bitcoin's value or value prop as store of value will also continue.
Super interesting. Sorry I cut out earlier, gentlemen. I'm confident you guys did justice to the Square block deal. But that was big news. Did you see the second Miles tweet around actual buyers being able to toggle on Bitcoin payments as well? Because someone had sort of replied to what was announced this morning, being like, is there a reason you guys decided to make the Bitcoin payment selection on the payer side, or to not do that? It would be way better UX if the payer didn't have to ask the merchant to pay in Bitcoin. And Miles responded to that, basically saying, coming soon. So basically now both sides are going to be able to toggle on Bitcoin payments if they'd like.
Yeah, that's what we kind of talked about. The innovations really like the Lightning working in the background to obfuscate either direction. So yeah, it's pretty bullish if you want to, if you're a Bitcoiner trying to accept payments, or if you just understand that the economics on interchange get better, because theoretically you could take the dollars in, convert it to Bitcoin, then convert it back to dollars. So use those rails. I know we're coming up on time. Do you want to just do the Coinbase and the IPO? I don't even know if there's a direct link. I think there was just a main theme of we're going to be in this like counterculture world of the people that are building. It's part of like discussing a lot of the fundamentals or lack of fundamentals of these companies is when we look at it from an investment perspective. What are the things delivering value to the world? Where's the unit economics that are going to persist? Because you can, in short run, maybe make something that's shiny, get investment. There was a recent one, like I think it's FXF or XFX. It was like cross border payments for like using stablecoins for FX, which they could build a great business. It's just like, well, what's the moat there, and like what's the differentiation? And point being is that you see all these different firms, and it's very heavily leaned into velocity and gambling. And so you've seen Coinbase, you see all over Twitter where they're across the board putting up, gambling as it relates. And I guess is with Kalshi, I think their relationship is for March Madness. But it's across the board, whether it's like, banks not giving you interest, charging you insane amounts around on your interest or credit cards. The Robinhood example, the IPOs that are getting pushed, like the SpaceX, versus what are the firms that are just helping you from a financial literacy, saving, preserving, growing your wealth. It's pretty bullish for what we're building, because I think like when we talk to clients, it really resonates with them. They appreciate it. They even appreciate that we talk about the DATs, because I think that they subtly know maybe that this isn't a long-term thing. And so I think this is just a microcosm for what's happening. But I think the long-term firms that persist are going to realize they have to take care of their client and not put them into these things. So it's just playing long-term games. And the reality is fast money, creates kind of more of a higher time preference society.
Yeah, 100%. The only thing I would add to that is like, it's also a function and a reflection of broken money, of the fiat monetary system, that we are in this place where people are so short-term oriented and financially nihilistic that they do feel the need or the expectation to go gamble to get ahead or get out from, under a bunch of credit card debt or whatever it may be, student loan debt. That is all downstream of the money being broken to some extent. And so in that sense, it's not entirely surprising that that's where we are in terms of whether it's Coinbase or DraftKings or Robinhood, all sort of becoming the same thing, which is super short-term thinking, gamble your way out of this, make it big. This is basically this is your only way to escape the permanent underclass type thinking. That is unfortunate. That's where we are. And so, yes, to your point, like we try to focus on being the opposite at Onramp, and particularly when we talk about Bitcoin and the investment thesis around it. It's savings technology. It's on the other side of speculation. It's how you actually plan long term. It's how you think long term. And so we need more of that in the market, needless to say.
100%. And especially anybody who is consumer facing should be thinking about their consumer more than anything else long term. And we've talked a lot about the needs for especially like DevOps and B2B2C AI development tools that are coming out now in marketplaces around that. We've seen a ton of nice adoptions or applications and emails from founders to the stables, kind of focusing on those sorts of things. So just want to shamelessly plug that Early Riders is running an accelerator for giving seed investments to folks who are really focused on, everything that we're kind of mentioning today of helping out the consumer long term rather than pushing them into financial nihilism, and making it easier for the agentic economy and businesses to create value long term. So if that's you and you're interested, please apply to earlyriders.com/stables.
Good stuff. All right. Thank you, gentlemen. See you guys next week.
Good stuff, guys.
Thanks,
Later.
guys.
Thanks for listening to this week's episode of the show. If you found the information valuable, please share the episode with a friend or leave a rating on your favorite podcast app. All the links we discussed in today's show will be in the show notes inside your podcast app. Before we finish, a quick reminder that Onramp Media is for informational and entertainment purposes only, and nothing should be construed as investment or legal advice. Regardless of where you are on your Bitcoin journey, we'd love to hear from you. Visit onrampbitcoin.com/contact to schedule a consultation with one of our private client advisors.